We're talking about Chinese equities today with Winson Fong, who helps manage about $2.5 billion as managing director at SG Asset Management. And their China fund was actually rated the best China fund at Japan's Lipper Awards recently. Okay, so Winson, before we went to break, we were talking about the property sector, and you said, well, it's maybe not a good place to short. It's also not a good place to go long, so it's probably just best to hold. Now, other sectors that you mentioned that you like include consumer, which has to be the consensus, I think, amongst most fund managers investing in China, and also related services sectors.
Well, for example, we are seeing a lot of consumption not only in the goods, but also in kind of services like tourism, travel. If you go to China, you will see everywhere all the tourist attractions. You will see millions of tourists from every part of the country. So related service meaning hotel, transportation, airlines, and also some booking service providers, such as a Sea Trip in the United States listed. So this kind of service-oriented stocks will continue to do good.
Now, in the consumer space, you recommend the retail chains, supermarkets, food, and beverage. What about some of those stocks that we see there, like Skyworth Digital? That's also a consumer, but I guess a tech-related sort of name. But you would recommend sort of these sort of sectors, these sort of entities, companies to invest in?
In fact, the Skyworth was one of my best bets last year. So it's a TV maker, very low tech element, but rather it's a consumer products. And that was a beneficiary of these stimulus subsidies last year. So it's the right product in the right time last year.
Now, are there any sectors worth avoiding at this point? Because Paul Gordon mentioned that if interest rates go up in China, that means the highly geared, highly leveraged companies basically have to pay more for their funding. So that's something to avoid. If interest rates do go up, they seem to be priced in. What else would you be avoiding at this point?
But usually not for this year, or on a short-term basis. We always try to avoid large cap stocks or IPPs, toll roads, because they are low growth. But being a China stocks, they expose themselves in a full amount of risk, policy risk, market risk, liquidity risk. So those are the areas we always want to avoid. And also, talking about interest rate and impact to highly geared companies, I think if you look at the China Eastern Airlines, this company basically is negative equity, but still they can survive. So in fact, the real impact of high interest rate to these highly indebted companies is not as big as you expect.
Okay, Winson, thank you for dropping by today. Nice seeing you. Winson Fong of SG Asset Management sharing his investment tips on the Chinese market.